This is Chapter 3, Managerial Accounting, from the textbook Garrison, Noreen Brewer. This will be delivered at native English mode. If you wish to have a recording in English as a second language, please check another audio posting that has the delivery of this content at a much slower pace. So let's get started. This chapter addresses cost behavior, analysis, and use. So both managers in the company as well as everyone in the accounting department and division need to understand how costs behave, and that enables us the ability to predict costs and make decisions based on various circumstances. The first time people hear cost behavior, one asks the question, what does this mean? How can a cost have a behavior? While in trading, we say that financial instruments have personalities. In the world of accounting, especially in managerial accounting, we talk about the behavior of costs and the behavior of accounts. So, as you remember, there are 5 types of accounts: assets, liabilities, owner's equity, revenue, expenses. So all of those types of accounts have a behavior, and accountants need to understand what types of transactions are represented in accounts. We define this as we define our accounting information system and as we define our chart of accounts. And this chapter focuses on the costs and how their behavior occurs. And when we understand how behavior works, the world of accounting and the world of business and nonprofits becomes much, much more clear. So we will be talking about fixed costs, variable costs, mixed costs, and the proportions with which those constitute an organization's cost structure. And we will also address the contribution approach to the P&L statement, or if you're in the United States, the contribution approach to the income statement. In the U.S., we say income statement. Outside the United States, we refer to this as the P&L, or profit and loss statement. So, learning objective number 1. How do fixed costs and variable costs behave, and how are we going to use them to predict or to forecast costs? And this is very key for managerial accounting because, as we said earlier, managerial accounting is forward-looking, financial accounting is backward-looking. Financial accounting records all the activities and posts them to the general ledger, and then we do the trial balance when we close the accounts, and then we generate the financial statements. That's financial accounting. Managerial accounting tends to be more along the line of budgets and forecasts and analysis, and this is one example of its behavior analysis and how costs act. And the key here is it helps us predict and make management decisions. So that's our objective number 1. So there are 2 major types of costs, variable and fixed. And the variable cost is defined as a cost whose dollar or yen or won or renminbi, so whatever currency. So the variable cost is a cost whose total dollar amount varies in direct proportion to changes in the activity level. Okay, so what does this mean? Look at the chart here on the next page, next slide. Total variable cost is proportional to the activity level within the relevant range. And we have a couple key words here. Relevant range. In accounting, both financial accounting and managerial accounting, we talk about the relevant range. And that's the activity level that we define as being relevant for a type of activity. So a variable cost moves in proportion to the underlying activity in a certain range. And that's on a total basis. Okay? Maybe the next slide helps it a little bit. What we look for in variable cost analysis is what's called a cost driver. It's also referred to as an activity base. And this refers to the measure of what causes a variable cost to occur. And an activity base is a measure what causes the incurrence of variable costs. And as the level of activity base increases, the total variable cost increases proportionally. So, for example, units sold is not the only activity base that occurs within organizations. A cost can be considered variable, for example, if it varies with the activity base such as miles driven, kilometers driven, machine hours, labor hours. So these are the very common drivers of costs, drivers of variable costs. So if we say it takes one person 1 hour to build a machine, a small machine, and that person works 1 hour on the machine, then his hourly rate, his wage and HR costs for that hour will be the variable cost. If it takes a person 10 hours to assemble a PC, then, and if he's making $10 an hour, so $10 an hour times 10 hours would be $100 for the variable costs for a PC. Likewise, if a robot is used and it takes the robot 2 hours to assemble a PC, and the machine hour is at $3 an hour, when we look at its underlying costs, then 2 hours times $3 would be 6 hours. So, the true variable cost is something we need to understand. And a common example is the cell phone. And here, the most common activity base or cost driver tends to be the number of minutes we talk on the phone. Now, there are many, many types of cell phone plans, so just stay with me on this. We'll explain on a simple level how costs can vary. So, when cell phones first came out 25 years ago, we would have plans that would say for every 1 minute you had to have 10 cents. So over the course of 1 month, if you had 100 minutes, it would be 100 minutes times 10 cents would be $10 in variable costs. So as the activity base, in this example, is minutes, the number of minutes used equals the variable cost at a variable cost rate. Very simple example. Now, moving on, the variable costs we look at in total and per unit. And many people get confused once we start going into this level of detail. So let's see what we mean. The variable cost per unit remains the same over wide ranges of activity. Well, what does this mean? We just talked about the cell phone example. The old cell phones used to work, so 10 cents for every 1 minute. So the per unit rate never changes. Okay? So 10 cents per unit, whether you spoke for 100 minutes, 1,000 minutes, 2,000 minutes, the variable rate per unit stayed constant. However, the total variable cost depends entirely upon the number of minutes that were used. Okay, so variable cost per unit remains constant and total changes. Another way to look at it. Okay, minutes talked per minute overage charge. The rate per minute does not change. The variable cost per unit does not change. It remains constant for a relevant range. We go back to that term. What is a relevant range? Well, let's talk about an example for cell phones. Maybe for every 100 minutes, there would be a variable cost per unit rate. So for the first 100 minutes, it would cost 10 cents per minute. For the next 100 minutes, it would cost 8 cents per minute. For the next 100 minutes, it would then cost 6 cents per minute. So each 100 minutes is a relevant range, and as one gets more and more usage, the variable cost per unit decreases. This is a common approach to cell phones or for many types of technology uses. Okay? Now, the extent of variable costs. The proportion of variable costs differs across organizations. And here we've got a public utility, a manufacturing company, a service company, and a merchandising company. So let's talk about what happens with public utility companies like Florida Power and Light, Duke Power, TEPCO, KEPCO. Throughout the world, there are public utilities, and these generate electricity. And in order to do that, there needs to be large investments in equipment. So there's significant capital costs, there's significant construction, development, time, and so these types of organizations or companies, such as utilities, have very few variable costs. Most of their costs are fixed. Most of their costs are because they're capital costs. Okay. In the case of a service industry, and what do we mean by a service industry? Well, that could be a law firm, public accounting firm, a doctor's office, an engineering office. A service company could be someone who paints buildings or washes windows or maintenance or cleaning companies. These are service companies. And they tend to have high variable costs and high fixed costs. Right? So they have both types because in order to do the service, you need a human being or a person actually spending time doing the work, whether it's manual work or professional services, but it usually involves human beings doing work, consuming time. So that would be a variable cost. A manufacturing company like Black & Decker and Panasonic and Sharp and General Electric frequently have many types of variable costs. And then a merchandising company has, such as Walmart or Daiei, tends to have a high proportion of variable costs, such as cost of goods sold. Okay, so depending upon the type of organization, the cost behavior and the types of costs tend to be different. Okay, so again, in merchandising companies such as Walmart, you've got cost of goods sold. In manufacturing companies, what are the types of variable costs? Well, you're going to have direct materials, direct labor, and variable overhead. In both merchandising and manufacturing companies, you tend to have commissions for sales, shipping costs, and clerical costs, back office costs. And lastly, service companies, we tend to see a lot of supplies, travel, clerical. So again, depending upon the type of organization, you'll see different types of variable costs. All right, moving on. So the amount of true variable costs used in the period depends directly upon the amount of usage, or the amount, it varies directly according to the activity level. And accountants always use a time period. So the most common type of time period tends to be a month. We tend to close the books every month. But in the case of variable costs, in this example, the period could be most likely a time period. Could be a minute, could be an hour, could be a day, could be a month. It varies in how we're trying to analyze it. So in the case of cell phones, the overage charge on a cell phone is a true variable cost. In the case of a manufacturing company, the actual direct material used in the creation of a product is considered variable. If we use 4 tires on every car, it is a direct material. Okay? We always use four tires on the car, so it's a variable cost. Now, let's take it one extra step. It's very simple to say the world exists for variable costs and fixed costs, but the world is not that simple. So there's always more complicated approaches. Here's step 1 in the process. A stepped variable cost is a resource that can be acquired in large chunks, large portions, and they change according to volume. And a common example is that people who support a company, workers who are maintenance workers, workers who are cleaning, workers do not charge by the minute. These types of people work by the day, by the week, by the month, and they are not pure variable, not 100% variable. So, for example, if we have a maintenance contract with someone who will always repair the electricity in the office environment, we will see them in a stepped variable cost. So there may be one person who can support 1 floor of our office, but let's say we expand onto 2 floors. Then we would have 1 person on each floor. So then we would have 2 people involved in the maintenance and support. Let's say we expand to a 3rd floor. Then we would have 3 people, 1 per floor, and so our costs would go up accordingly. It would have the behavior of a step pattern. So those are steps. So small changes in the level of production are not likely to have an effect on the number of maintenance workers employed. So, exactly. If you imagine Toyota or General Motors, again, it comes back to a relevant range. If there's going to be 1 8-hour shift in a plant, then we probably need a certain team of maintenance workers. But then let's say the sales forecast goes up, Toyota or General Motors decides to put a 2nd shift in place to produce more cars, then we would need another team of maintenance and support people. So then let's say sales really take off and Toyota or General Motors decides to go to 3rd shift. So we have 3 8-hour shifts. Maintenance and support people only work an 8-hour shift. So with each additional shift of work, we would have another team of maintenance workers come on. So you can see the cost behavior in a step variable pattern. Now, sometimes it takes a wide range and change in activity to do the next step, to move up. So it all depends on the nature of the operation, whether it's manufacturing, whether it's assembly, and it depends on the industry and the company. I was an accountant in university, and we tended to use curves like this. It's a curvilinear cost function. But accountants tend not to think in such terms, okay? Economists point out that many costs, as classified as variable costs, actually behave like a curve, okay? But we accountants like straight lines. We tend to be more binary, and it's either yes, no, black, white, straight line. We don't like curves as much. So, in the case of, again, using the relevant range, we can get very comfortable with a straight line. Okay? Here's the relevant range. So in that zone, you can see that both the curvilinear function and the straight line map pretty closely. So they approximate the same values. Moving on, let's talk about fixed costs. This is the second major category. In our chart, which we now have with showing variable and fixed, the total fixed costs tend to remain the same even when the activity level changes within the relevant range. So again, we're using a couple important terms, the relevant range. Accountants like to use this. So between this level of output, between 100 cars and 200 cars is a relevant range for a one day's output. So the total fixed costs remain the same in this range of activity. That is on a total basis, okay? So moving back to the example of cell phones, 25 years ago there was no fixed costs. It tended to be 100% variable. Then, as the industry changed, we see that the costs of cell phones tend to be also include a fixed cost portion, and that is, even if we don't use the cell phone at all, we will have to pay a minimum charge. So, for example, my phone in Japan costs 5,000 yen per month, even if I do not use it. In the United States, it's running at $50 a month, even if I do not use the cell phone. So that would be the fixed cost. So it doesn't matter if I use the cell phone 1 minute, 100 minutes, 1,000 minutes, there is a fixed cost amount in many common cell phone plans. Okay? The total doesn't change. But if you consider it on a per unit basis, the average fixed cost per unit actually decreases the more volume that's used. And this makes sense. If we only use the cell phone for 1 minute and the monthly fixed cost is $50, that 1 minute has a fixed cost of $50. If we use it for 100 minutes, then the $50 is divided by 100 minutes, and we would be running at 50 cents per minute. So the unit rate, the unit fixed cost will decrease as volume increases. And so we see the classic curve. So when, and this is very common when we create new products, what is the cost for the initial product? It tends to be high. So when we create our first product, total costs are high. Likewise with the fixed cost per unit curve. If we're only going to use 10 minutes, the fixed cost per minute is high. But the more calls we make, the more minutes we use, the cost per minute will decrease. Classic case. Take it one extra step. If we create only one car, the fixed cost per car will be high. If we create 1 million cars, the fixed cost per car will be spread over 1 million cars. It would be less. So, what are the types of fixed costs? Well, we have two major types. First type is called committed. And a committed fixed cost means we cannot change it. We are locked into it. We can't renegotiate. We are stuck. We will have to pay that cost. We will have to incur that cost during the short term. And the most common examples tend to be what's the depreciation on a building, what are the real estate taxes, what's the depreciation on equipment, what's the amortization on patents, what's the amortization on intellectual property. Those tend to be fixed in the short term. Now, the other major type of fixed costs is discretionary. And the word discretionary means we can actually make changes to it in the relevant range or during the time zone. So management could take a decision that we will make a change and therefore the fixed costs will change accordingly. And the example tends to be advertising, research and development. We can immediately increase or we could immediately decrease types of advertising. We could, likewise with R&D, we could abruptly stop it. We could alternatively significantly increase it. So if it's discretionary, then we can change it. There tends to be a trend towards fixed costs. And why is this? In the G20 countries, we tend to see that there are fewer and fewer laborers and human beings involved in work. And the level of intelligence, the level of training, the level of knowledge that's required to do the work of the company, the work of the nonprofit, tends to be done more and more by knowledge workers. Okay? And machines and automation and workflow technology tend to do the repetitive, low-level, mundane, boring type of work. This is how the G20 countries are moving, and so we see workers tend to get paid a salary that workers cannot charge by the minute. Now, professional service firms, such as a law firm, tends to charge every 10 minutes. So if you hire a lawyer, he's charging every 10 minutes of his work. But if you're dealing with humans in-house as employees, they don't charge by 10 minutes. We tend to think of salary by month. Okay? So, likewise, as workflow technology and machines and robots accomplishes the repetitive work, the high-skilled, intelligent knowledge workers who are trained with very specific skills tend to have a higher cost. They have salaries, they have skills, companies have to pay for that salaries, companies have to pay for those skill sets. So knowledge workers are more expensive than laborers. So the cost of paying these employees is usually fixed, relatively fixed. Now, all the world is not the same. We can look at various countries and see quite a difference when it comes to variable costs or fixed costs, especially in the area of salaries, wages, human resource, and that type of cost account. In Europe, where laws exist to protect employees, and it makes it very difficult for companies to terminate employees, there is not much flexibility in making quick adjustments to the labor, to the team. So if a factory has 100 workers in France or 100 workers in Germany, it's very difficult to quickly go down to 50 workers and then maybe ramp up to 150 during the busy season, then come back down to 75 or 50 in a slow season. That's very difficult to make those types of changes in Europe, such as France, Germany, Spain, because the labor laws make it such that if a company or a nonprofit actually offer employment, it's very difficult to terminate the employee. Very difficult, very expensive. China and Japan are similar. It's not easy to ask someone to leave because of their performance or for whatever reason. So those types of countries have less flexibility in adjusting the HR teams, the teams that actually provide the company's staffing levels. In the United States and also in the UK, we have what's called a Right to Work Act. And that means that the employer or the company or the organization can terminate the employment of someone in one day, as long as they do it for allowed reasons, legal reasons, and do not engage in discrimination or other activities. It tends to be okay. So one day a person could go to the office and find that they no longer have a job. They are taken away and given their benefits, their termination, their exit package, and then they're asked to leave. Okay? The UK is also very similar in this regards. So this means that the labor costs tend to be very variable. They're not fixed because there's great opportunity for a company to suddenly double its labor force, then the next month or two they could cut it in half. So great flexibility. And lastly, the attitude of both the workforce and the company employees is much different. For example, if you know that you have no job security, that you can be terminated tomorrow, that you may not be there a year, 5 years, or 10 years, it affects how you spend your money. If you know you have no security, you could be booted out, you are less eager, you're more reluctant to make big purchases. So you find in places that have no job security, you will find fewer people buying homes, fewer people getting married, fewer people having families, because there's too much lack of stability. So it has a significant ripple effect. Likewise, in Europe, with Manpower and Adecco and the temporary job service companies, those organizations thrive because companies need to accomplish work. The only question is, do the companies employ people on a salaried employment contract basis, or are they day-to-day based laborers? If you are in a country or a market where day-to-day you could be terminated for your job, then likewise you have little interest in making a purchase commitment to something like a house or a personal relationship such as a marriage or having children, because you don't know how long you will be employed and have a steady cash inflow from your employment source. So again, we go back to fixed costs and the relevant range. Let's talk about that for a second. So here we see an example of an office area, and for example, at Temple University, we could have one floor. Each floor in our key building, our headquarters, would have 1,000 square feet or 1,000 square meters. So if we start with one floor, we will need 1,000 square meters. Let's say more and more students come, then we need a second floor. So here we have a stepped relationship, so we need to add a second floor. So then we go to 2,000 square feet in total, but it's stepped every 1,000 square feet or 1,000 square meters. So the relevant range of activity in this example for fixed costs is the range over which the graph of the cost is flat. Okay? So here we see that, let's say in a year, the office space is $30,000, and for every 1,000 square feet, the fixed cost would increase in a step fashion at a rate of $30,000 for each additional 1,000 square feet. Now, how does the step function behavior, how does the step function pattern differ from a step variable cost? Well, the answer is on the right. First, the step variable costs can often be adjusted quickly as conditions change, or whereas fixed costs cannot change easily. So, okay, fixed costs tend to be locked in. You can imagine the example of the TEPCO or PEPCO power plant utility company. Very difficult to change fixed costs because it tends to be huge investments, capital intensive. But the second difference is that the width of the steps of a step function is wider than the width of the steps for the step variable cost. So let's see, what's an example? The step variable cost for maintenance workers may have steps with the width of about 40 hours a week. So the average worker works 40 hours a week. So for step variable, for every 40 hours, there would be a step. Fixed costs would be steps that have a width of, say, thousands of hours or tens of thousands of hours of activity. Okay, let's do a check. Okay. Which of the following statements is true about cost behavior? Fixed costs per unit vary with the level of activity. That sounds pretty good. Fixed costs per unit, that's the key. Per unit will vary with the level of activity. Well, maybe not, huh? Because the level of activity in fixed can be significant. B, variable costs per unit are constant within the relevant range. So what was our example? The cell phone example. For every 1 minute, it costs 10 cents. For every 1 minute, it costs 10 yen. In this case, the variable costs per unit are constant within the relevant range. That sounds good. Let's go on to C. Total fixed costs are constant within the relevant range. Well, that sounds pretty good, doesn't it? Fixed costs don't change in a range. No. Okay, so that sounds good. Total variable costs are constant within the relevant range. Well, total variable costs will vary in a range because it links with the driver. So what do we got here? A, B, and C. The only one that's not true is the last one. Total variable costs are constant. The variable cost is constant per unit, not in total. Therefore, the only one that's not correct is the last one. Okay, let's move on. Get the next slide. Let's talk about mixed costs, which are also referred to as semi-variable costs. And in this, we see kind of a difficult pattern, but as we talk it through, I think you'll understand it. Let's take the example, okay, of a utility company like TEPCO in Japan or PEPCO in the United States or Duke Power or Florida Power and Light. In this case, we have, what's our activity going to be? Kilowatt hours. Easy to understand. The amount of power per hour is the activity level. And then the total utility cost is the cost of fixed and variable behaviors. So what do we have here? Like remember earlier slides, we had a fixed monthly utility charge or a fixed monthly cell phone charge. That's a horizontal line. That total fixed charge doesn't change. Okay. Now then we put on top of that the variable cost per activity unit. So we see that the total mixed cost, which would be a combination of variable and fixed, tends to be portrayed here. Okay. So the total mixed cost line tends to be expressed as a quadratic. It's not a quadratic, it's a simple y equals a plus bx formula. And in this case, y is the mixed cost, and the total fixed cost in this equation is a. And b is the variable cost per unit of activity. Okay, and x is the level of activity. That will give us the total mixed cost. Total mixed costs are the total variable costs, total fixed costs. Okay? So let's go straight to an example. Using our TEPCO or PEPCO or Duke Power example, we get a monthly invoice from the utility company. And let's say it's $40 or 4,000 yen, and the variable portion is 3 yen or 3 cents per kilowatt hour, and we use 2,000 kilowatt hours in a month. So what's going to be the total amount of the bill? So let's take a little analysis on this. Using that formula, it's going to be y, what's the formula? Y equals a plus bx. So what's our fixed component? It's going to be the $40 fixed amount. And what's going to be our variable? It's going to be 3 cents or 3 yen per hour used, per kilowatt hour used. So we got 3 cents times 2,000 kilowatt hours. So it's going to be 40 plus 60 equals 100. That would be our example. Now, in some organizations, it gets very complex very fast, and there is a preference to use an engineering approach, not just the accounting approach, but an engineering approach classifies costs based upon the work of an engineer. So the engineer is going to look at production methods, amount of material, amount of labor, overhead requirements, and come up with very sophisticated analysis. So the engineering approach is particularly helpful if we really have no experience in understanding the activity and the cost. So it might be a new plant or a new building or a new process. We have no experience, we have no reference sites, we have no reference, we have no feeling for it. So we tend to get a subject matter expert, an engineer, will come in and do the analysis, and that will be the basis of our behavior. cost behavior. If we have experience or we know the situation, then we tend to rely more upon account analysis. And this is where each account is classified as either variable or fixed, and we really know how the account behaves. So, how do we get rid of some of these costs? How do we manage them? How do we understand them? So, how do we convert fixed costs to variable costs? We can do it through such ways as outsourcing. So in this example, what are some very common fixed costs? Well, it tends to be the facilities that produce the product or assemble the product, rental agreements, the salary, the HR costs, benefits, and utilities. So they tend to be very fixed cost based. And if we convert them into variable, we could have a significant risk of financial commitment and capacity utilization. So when it comes to outsourcing, what is outsourcing? That's when a company or organization decides to use an outside vendor to accomplish a task. So perhaps the IT department and all its equipment and all its staff are better accomplished outside the organization. And you see this frequently with small companies who do not want to invest in the employees, and they strike an outsourcing arrangement or a service level arrangement with an outside IT company. And so then a monthly invoice is rendered and there's a whole series of agreements made to accomplish outsourcing. It tends to be common in when we outsource, we tend to outsource non-core business functions with lower value add. Okay, so common call centers used to be the point where customers would place a telephone call, they need help, you want to talk to a human being. Over the decades, there was a movement outsourcing all of that call activity to people outside the company. Okay, and then logistics or securities, back office operations. A lot of these types of subject areas tend to go outside the organization, and there's a cost arrangement, a billing arrangement, a service level arrangement that's made. Offshoring is the concept of making the products or services outside the country where the business is occurring. So there was a huge movement, huge offshoring movement from the U.S. to India. Well, went to India. Call centers. Well, went to the Philippines. Call centers. Why? India and Philippines have English language as native language. Therefore, they could support the United States at a lower cost than could call centers that were based in the U.S. Manufacturing. So as manufacturing gets perfected and rationalized, we find that car makers, truck makers moving away from their home base as far as manufacturing and using offshore subsidiaries to do it. Okay. Now, moving on, learning objective number 2. In certain circumstances, scatter plots can be used to understand cost behavior. This is learning objective number 2. So let's just touch briefly on what this means, because not too many companies, not too many organizations use a scatter plot. Some do. Depends on how complicated the nature of the business is. But if you've taken statistics or statistics course or statistical analysis, this is you plot the activity, and the first step. Well, a scatter plot can also be a quick and dirty method to determine fixed and variable components of a mixed cost, and you're going to see this. The first step is to analyze the mixed cost and to plot the data on a scatter graph. So you have a y-axis and an x-axis. The cost is the dependent variable, and this is on the y-axis, so the one going up and down. On the left is the y-axis, and that's the dependent variable, that's the cost. The activity is the driver, and that's known as the independent variable, and is on the horizontal axis, going from left to right. Then, after we plotted that, understood that, the second step is to examine the dots on the graph, on the scatter graph, and see if there's any linear relationship that we could identify. So we would draw a line through them to see how it might be a pattern that could be identified, and then if we have a straight line, we can do an equation that can be used to calculate forecasts. So one data point to estimate the total level of activity and the total cost. So if we're able to do a scatter graph and plot the data, and it's not too dispersed, and we can put a line through it, and it's reasonably clustered around the line, then we can use that line as a predictor of a specific number of activities on the horizontal axis and the variables on the left. Okay, so in this example, how many patient days are there? There's 800, and what's the total maintenance cost? Would be 11,000. So it can be helpful. Now, moving on, let's take a quick estimate of the variable cost per unit and determine the cost equation. So here we've got 800 patients. Take away the fixed costs, and then we have what's going to be determined as a variable cost. In this example, 1,000. So the variable cost per unit, well, how many units are there? 800 patients. What's the variable cost? $1,000. So do the division, and you come up with a rate that can be used to predict future costs. So here comes our equation. $10,000 is the fixed component. $1.25 is the variable cost per unit. Total maintenance, number of patient days. Now, we can continue, and we can use what's called the mixed cost high-low method. I have never seen this used in an organization, but if you have an interest, you can spend the time and go through this PowerPoint. In all my years of experience in industry and consulting, we never used this approach. Okay? But you can follow it in the chart. You can also read it in the textbook, and you can come up with that. Now, moving on. Let's move on to learning objective number 4, because this is very helpful. Learning objective number 4, least squares regression method, also not used very widely in the business world. Okay, learning objective number 4. Let's prepare an income statement or profit and loss statement using the contribution format. This is the key to managerial accounting. What is the contribution format? Okay, the most important financial statement, arguably, in organizations tends to be the profit and loss statement, the income statement. Why is that? Because if you're a publicly listed company or a company of significant size, you're interested in what's called the bottom line. The bottom line means how much profit has been made in the organization. If you're publicly traded, then that means you have shares trading on an exchange. Okay? People want the value of the shares to go up, usually. So what drives share price? Well, buy-sell activity does on a minute-by-minute basis when an exchange is open, but more importantly, there are earnings seasons 4 times a year. When the calendar quarter closes, we then publish the financial statements, and everyone tends to look at the income statement, or also known as P&L statement. We'll look at the bottom line, and then we look at the net income, and we then calculate the earnings per share. What are earnings per share? It's taking the net income after any dividends, dividing it by total number of shares outstanding. That will give the viewer the earnings per share. And as earnings per share goes up, so does the share price usually. So, from the managerial accounting perspective, we look at the P&L statement in a different way. We start the same. Sales revenue is always on top. Then we we reduce the variable costs involved. And then we come to what's called the contribution margin. Okay, this is a key term. The contribution margin appears on contribution format P&Ls. So in this case, $40,000 is our contribution margin because we had $60,000 in variable costs. Now, after we got a contribution margin, we reduce that by fixed costs. In this example, our fixed costs were $30,000. So congratulations, this organization had a $10,000 operating income, net operating profit. So here we know that the contribution from the sales covered and exceeded the fixed costs. Therefore, there was a profit, there was an income. Now, contribution format emphasizes cost behavior, okay? And the whole way of thinking is, let's generate enough sales, which generates enough contribution margin to cover our fixed costs. And in this case, what are examples of fixed costs? Well, everybody's salaries are on a fixed cost basis. Rent. Many types of expenses tend to be fixed cost behavior. We must generate enough sales that has enough margin to cover those fixed costs. Now, that's on a total basis. We also like to use it on a per unit basis. So on the right, you see there are $100,000 of sales revenue. Per unit is $50. So how many units did we sell? Probably 2,000. 2,000 units times $50 per unit cost, per unit sales price comes up with $100,000. So we like to calculate it and look at it on a total basis and a per unit basis. Now, later in this course and later in the lectures, we'll talk about very important analytical approaches: cost, volume, profit analysis, the way we budget, the way we do segmented reporting, and special decisions such as pricing or make-buy analysis. Contribution format is the key way of reporting profit and loss in an organization. Now, two types of approaches. Okay, the contribution income statement with the traditional income statement approach. Okay, look on the left. This is also referred to as financial accounting. On the right, managerial accounting. Again, financial accounting reports. Who uses them? Outsiders. They must follow GAAP. In contrast, on the right, we tend to use them inside the organization. They do not have to follow GAAP. Do not follow GAAP. One reason, we don't publish them outside the organization. So back on the left, the traditional approach. Start with sales. We take away cost of goods sold, come up with gross margin. Then we subtract operating expenses, come up with net income. Classic approach. On the right, we see managerial accounting approach. It's different. Top line's the same. Sales, no change. $100,000 in sales on the left, $100,000 in sales on the right. No change. However, look at the next row. Cost of goods sold is the way we report it per GAAP in financial accounting reports. But from a managerial accounting perspective, we report it as variable expenses. We separate variable and fixed expenses when we look at it as managerial accountants. Okay? See it highlighted in red? Variable expenses. That, taken away from sales, gives us contribution margin. Is the contribution margin greater than fixed expenses? In this case, yes. Congratulations, profitable organization. Over here, however, we see the two rows having different names. Cost of goods sold. So within cost of goods sold, we have both variable and fixed expenses. Okay? And then operating expenses can be the same. We have a variable type of expenses, we have fixed type of expenses. So the bottom line is the same, the top line is the same, but the interim lines or rows are different. Very important concept. Okay, well, this brings to an end Chapter 3. The least squares regression computation, rarely used in small or medium-sized businesses. It takes a very special organization to get into least squares regression. And if you have an interest in this, you can review it over the last pages of this PowerPoint deck. So with that, we are concluding this third chapter.